This is Nightly Business Report with Tyler Matheson and Susie Guerin. Brought to you in part by
TheStreet.com, featuring Stephanie Link, who shares her investment strategies, stock picks, and market insights with Action Alerts Plus, the multi-million-dollar portfolio she manages with Jim Cramer. You can learn more at TheStreet.com/NBR.
Rally mode. Stocks powered higher on one of the busiest earnings days of the year. And it was driven by two old and staid blue chips that many consider bellwethers for the global economy.
Red is the new black. Amazon still isn't making money, reporting a wider than expected loss, and its outlook for sales isn't much brighter.
And life in the clouds. Does Microsoft's strong quarter show the company's push into cloud computing is paying off? We have all that and more tonight on Nightly Business Report for Thursday, October 23rd.
Good evening, everyone, and welcome. A solid bounce-back rally on Wall Street today as strong corporate earnings from a pair of big blue-chip industrial giants helped erase all of yesterday's losses and then some. Not even a spike in initial jobless claims or a new possible but unconfirmed case of Ebola in the U.S. could dampen investors' appetites for stocks today. It turned out to be one of the best days of the year for equities. At the closing bell, the Dow was up 216 points after briefly seeing a 300-point gain. The Nasdaq higher by 70, and the S&P 500 added 23. Bob Pisani now with more on what was behind today's rally from the floor of the New York Stock Exchange.
Stocks stage another impressive rally today. What exactly is going on? Well, there's two factors that seem most important. First, there's earnings. By the end of the day, almost 40% of the S&P 500 will have reported for this quarter, and the numbers have been very good. Today, for example, strong reports from 3M and Caterpillar and Union Pacific lifted the industrials and the transports. A strong report from Diamond Offshore lifted oil drillers. Excellent reports in the automotive space from Group 1, Dana, and O'Reilly also lifted that sector. And one important point, the commentary on weakness in Europe has not been as dire as some feared. Weakness in Europe has been mentioned by a number of companies, but the concerns have been offset by comments about strength in the U.S. or even in China. The second factor is hedge funds have been forced back into the market. In recent days, they have been very active buyers. Now, there's several other factors that were helpful to stocks today. First, oil has stabilized in the low 80s. Second, China's manufacturing number was slightly better than expected. Third, there's some relief that the terrible incident in Canada yesterday appears to be the work of a lone wolf. Finally, news that a New York City doctor who had been treating Ebola patients in West Africa had been taken to a New York City hospital with a high fever knocked about 80 points off the Dow's 300-point rally in the final hour of trading. It's a very good reminder that concerns about Ebola have not gone away, but it's also a sign that the market may be becoming a bit more nuanced in its reaction to Ebola stories. I mean, let's face it, if this story would have happened 2 weeks ago with the Dow up 300 points, it's likely the Dow would have dropped 200 points, not 80 points, on this news. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
Now, after the closing bell, it was the tale of two tech stocks, earnings from tech bellwethers Amazon and Microsoft, and the results couldn't have been more different. We begin with Amazon.com and the e-commerce giant's huge miss, reporting a loss of 95 cents per share, much bigger than the 74 cents that analysts had forecasted. Revenues also came in below expectations, but only by a fraction, and the number increased from last year. Amazon's sales guidance for the crucial holiday quarter also came in below Wall Street estimates. Shares plunged nearly 11% in after-hours trading. They were flat in the regular session today. Bertha Coombe joins us now from the NASDAQ exchange with the one big takeaway from Amazon's disappointing report. Bertha?
You know, Susie, I think increasingly people on the street are saying we love using Amazon. A lot of folks love using it. There are a lot of consumers who really like the service. But it seems as though Amazon can deliver on everything except earnings and profits. And for a long time, because they were growing so fast, a lot of investors forgave them that. But that time is now drawing to a close. And people are starting to say, maybe you're just in too many things. You're in content, you're in devices that you now give away for free. You're also increasing your delivery options. But when are you going to pay us with better profits?
All All right, Bertha, stay right there if you don't mind as we look now at Microsoft's very, very different story. The software giant topped forecast. It took in 54 cents a share. That was a full nickel above analyst estimates. Revenues, $23 billion, were $1 billion more than forecast and much higher than they were a year ago, as you see right there. But net income did fall 13% from last year. This after the firm took a more than $1 billion charge related to mass layoffs in its Nokia handset division. At the same time, Nokia handset sales were actually strong. Shares of Microsoft initially moving higher, sharply so, as you see there in the after hours. Bertha, once again at the NASDAQ, the big takeaway for you from these numbers from Mr. Softy.
Microsoft is cool again. Satya Nadella took over in February from Steve Ballmer, and he has really set a tone of modernizing Microsoft, moving away from software sales, from those little packets and disks to on the cloud. That's where things are moving, and also moving more towards mobile. The cloud computing revenues doubled, still not a huge part, but it just shows that he's starting to change this big and turn this big ship around. And for now, the honeymoon continues for him.
All right, Bertha, thank you so much for reporting on both of those companies. Now, let's bring in David Garrity to talk more about Microsoft and Amazon. He's principal at GVA Research. David, let me just start out by saying that I know going into these earnings reports, you were not recommending Microsoft or Amazon. Now that you see the after-hours reaction with Amazon's stock down sharply 11%, Microsoft's up sharply, have you changed your opinion?
Well, in terms of Amazon, we still would be probably even avoiding the stock maybe as a holiday year-end shopping trade, just given the disappointment we were seeing in terms of revenue guidance for the December quarter. I mean, there are some concerns here quite clearly with respect to Amazon. We don't really see a lot in terms of profits falling to the bottom line. We have seen good sales growth, but that sales growth is decelerating. And anytime you're seeing a stock that's trading very, very high multiples in terms of earnings, slowing growth is death. As far as the stock is concerned, we're not surprised to see it down so much after hours.
What about Microsoft? Microsoft's numbers were pretty good. They've got a new CEO, albeit one with a somewhat controversial pay package. What do you think of Microsoft, and do you like it anymore today? You have a hold on it.
Well, in terms of Microsoft, seeing this very nice acceleration in terms of the revenue growth. I mean, the revenue growth at Microsoft up 25% year over year, obviously up better than the 20% we saw from Amazon. But certainly that revenue growth is being driven by some fairly high profit margin areas. They're a cloud computing initiative where they're taking share away from the likes of IBM and also potentially away also from Amazon. I mean, certainly we think with regards to Microsoft, there are some challenges. They have some legacy businesses, which are very profitable, but where there's slow growth. And we do have to see how is the company going to re-engineer its breadth in order to get the stock over $50. But we do like Microsoft here. We'd continue to hold. Obviously, Amazon, we were thinking there might have been a trade going into year-end. Looking at these numbers, we would reserve judgment.
Bertha brought up two interesting points on both of these companies. With Microsoft, she's saying it's cool again. It's a cool stock. I wanted to get your thoughts on that. And then about Amazon, saying that some investors saying it's in just too many things, and when are they going to deliver a profit? Your thoughts on both of these?
Well, in terms of Microsoft, I mean, we do have some very nice upgrades taking place in terms of their Xbox game console, but that's something that's probably a once-in-a-decade phenomenon, so we can say if it's cool, it's only temporarily so. In terms of the cloud computing initiative, certainly we need to see continued progress there. I would say, if people wanted to look at a company that was cool, obviously you have to look at Apple, and then when you size up Microsoft against Apple, Microsoft looks maybe a little more attractive, but not necessarily cool.
So I was going to ask you if these two big mega cap tech stocks aren't particularly your taste right now, what is? You mentioned one, Apple. Are there any others in sort of mega cap tech land that you like?
Well, we think, Apple clearly, Google, despite the fact that they had somewhat disappointing results, we think is set up well for the end of the year. We think Google over the next 12 months could be potentially a $700 stock. We also like Facebook, which we think, showing very solid growth metrics and a valuation that's attractive, selling less than 1.5 times its growth rate. So we think that Facebook selling at about in the low 70s probably could be somewhere up near 100 within the next 6 to 12 months.
All right. Lots of good information. Thanks a lot, David. David Garrity with GVA Research.
More now on those strong before the bell earnings from the industrial giant 3M, which makes everything from Post-it notes to Scotch tape to ceramics. Profits there up 6% last quarter as it sold more materials to automakers and electronics manufacturers. 3M also lowered the high end and raised the low end of its full-year earnings guidance. Shares were among the biggest gainers in the Dow today. They were up about 4.5%.
But the biggest gainer in the Dow today, Caterpillar, the industrial equipment giant. The stock surged 5% after Cat reported quarterly earnings that topped forecasts. The company says the solid results were helped by cost cuts and by strong sales of construction and oil drilling machines. So what's the outlook for Caterpillar in the year ahead? Dominic Chu takes a look.
Among the most closely followed earnings reports each season is that of Caterpillar. Their bulldozers, dump trucks, and other heavy machinery are used by everyone from miners to oil drillers to construction workers, and they're used all over the world. That's why many investors use the company as a barometer or gauge of global economic health. Caterpillar reported stronger than expected profits and sales, and it raised its full-year profit forecast, thanks to increased demand from the North American construction, oil, and gas markets. The strength in Caterpillar stock helped fuel gains in the overall stock market. But while many traders and investors focused on the stock gains, other experts are a little bit more cautious on the company's outlook.
One of the reasons we're neutral on Caterpillar heading into 2015 is exactly on that thesis. With oil prices coming down, if they fall further going into 2015, that it will impact many of Caterpillar's businesses, not just its engine, oil and gas business.
Cautious optimism is also how Caterpillar is approaching the coming year. It says that there's a reasonable likelihood that world economic growth could improve in 2015, and that there's the potential for increased infrastructure investment in places like India, Turkey, and the United States. So, more roads, bridges, tunnels, etc. But don't expect it to be off to the races.
The recovery is going to be slow, and if you look at our sales history over my career, almost 40 years at Caterpillar, most recoveries come out of the blocks pretty fast. We even saw that in 10, 11, and 12. This one is probably going to be a lot slower, and in a way it's probably good for Caterpillar, maybe good for the world, arguably.
Caterpillar's results are giving bullish investors a reason to stay that way. Now Wall Street will wait to see if other earnings reports this season will validate that view. For Nightly Business Report, I'm Dominic Chu.
Another big name out with solid earnings this morning was General Motors. Despite 75 recalls of more than 30 million vehicles in the first half of the year, GM had its best third quarter since 1980. Surging demand for pickups and SUVs helped offset weak sales in Europe and South America. But Chuck Stevens, GM's chief financial officer, is upbeat on sales forecasts outside the U.S.
Europe, again, very much on plan towards executing to profitability in 2016. And China, as we said, we expect China industry to grow, our share in revenue to grow faster than the industry, and to maintain those margins.
Despite that optimism and the good report, shares of the automaker were down today by more than 1%.
Moving from the roads to the skies, with more Americans flying and oil prices falling to $82 a barrel, a handful of U.S. carriers reported very strong third-quarter earnings. That helped shares of United Continental, American, and Alaska Air take off today. Phil LeBeau has more on why shares of the airlines are soaring.
Pardon the pun, but the airline industry is soaring. The combination of strong demand, a limited number of seats to support higher ticket prices, and moderate jet fuel prices have combined to make it a profitable third quarter on the runway. Depending on the carrier, profits jumped between 27 and 97%.
From a macro perspective, the economy's been more stable this year. Energy prices have been very stable for really close to the last 2 years until the recent drops. And then travel demand has been very strong.
The robust earnings are a welcome relief for shareholders who in recent weeks have watched their airline stocks come under pressure due to fears the Ebola virus would scare travelers into delaying or canceling future trips. But while discussing earnings, executives at several airlines said they haven't seen a drop in future bookings.
The airlines are now set up for a strong holiday travel season, which is good news for them, but not as much for you if you're planning a trip. Because demand is not slowing down, if you're planning to take a trip before the end of the year, don't expect to find many airfare deals. Phil LeBeau, Nightly Business Report, Chicago.
Still ahead, the rail industry is racing to keep up with strong demand. Sounds like a good thing, right? So why is it turning into a big headache for the railroads? A new warning from the U.S. government: do not buy oil from ISIS. The Obama administration says it will slap sanctions on anyone who buys oil from the Islamic militants in Syria and Iraq. It is estimated that ISIS makes $1 million a day from refining and selling crude to smugglers who bring much of the oil out of Syria and Iraq and then transport it through Turkey.
Back here in the U.S., a lot of oil travels by rail, and carrying more freight at higher rates helped Union Pacific Railroad deliver a 19% jump in profit last quarter. With the company's CEO predicting record results for the full year, shares today chugged 5% higher.
But with more goods moving across the country by rail, gridlock has become an increasingly large problem on the nation's rails, already costing operators billions. Railroad companies are steamed. So what's the industry doing to try to relieve the pressure? Morgan Brennan has our story.
Railroad operators have seen surging freight volumes as more goods move by train. The Association of American Railroads says so far this year, volumes nearly 4% higher than the same period in 2013. And that's expected to continue as the U.S. economy recovers and this type of transport proves more cost-effective than trucking. But the growth comes with a catch. It's causing congestion. Beyond the harsh winter, we've seen backlogs, delays, and service interruptions. And the boom in energy is one key reason.
We've seen a big impact on our railroad from growth in the energy business, from frac sand to natural gas liquids to crude oil. We've got a lot of infrastructure and a lot of work going on, but right now we just have a slower network, and that affects every train on the network.
This issue manifests in choke points like Chicago, where all the rail networks converge. It's why Canadian Pacific approached CSX about a now defunct merger, because CEO Hunter Harrison expects, quote, the worst gridlock ever if the industry continues as is. But other operators, CSX, Norfolk Southern, and today Union Pacific, say M&A won't help the problem. They're investing billions into more trains and crews and better technology to make networks more efficient. And just today, a new railroad bridge meant to help ease traffic in Chicago opened for business. Analysts expect congestion to continue into 2015, but ease up as all of these plans come online.
Towards the end of 2015, we would expect to see some of these service issues start to right themselves. Obviously, a merger could, in our opinion, go a long way towards improving them over the very long term. When you think out sort of 3, 5, 6 years beyond that, you could see the mergers ultimately have some benefit here. I think in the shorter term, we're going to be seeing additional crews and additional locomotives really trying to do most of the work.
Weatherby notes that some companies grapple with congestion more than others. Berkshire Hathaway's BNSF has struggled all year, and Norfolk Southern has experienced issues for the past 2 quarters. Nonetheless, it's an issue everyone in the industry is watching and watching closely, since delays can translate into higher costs for the railroads and ultimately fewer customers. For Nightly Business Report, I'm Morgan Brennan.
We begin Market Focus tonight with Pfizer announcing a massive share buyback. Its board approved an $11 billion share repurchase program. This is in addition to what's remaining on its current buyback program, which works out a little over $1 billion. On top of that, the drug maker will be returning more cash to shareholders with its new dividend worth 26 cents a share that'll be payable in December. Shares spiked when the news came out after the bell. The stock was up 1% in regular trading, closing at $28.60. An improving housing market helped Pulte Group. Home builders' third-quarter profit and revenue topped estimates thanks to an improving economy and higher selling prices. It also hiked its quarterly dividend by about 60% to 8 cents a share, and it announced a plan to raise its share buyback program by $750 million. Shares popped almost 2% to $19.51. Eli Lilly is one company that didn't participate in today's rally. Shares fell after the drug maker said its quarterly earnings plunged almost 60%, hurt by special charges and generic competition for its depression drug. The company is still optimistic when it comes to business in the U.S., but the CEO says Europe is another story.
I think Europe is a little bit more of a challenge as the economy sort of remains stuck in many countries in Europe. That, of course, affects the government decision about things like reimbursement of medicine. So our business in Europe has been somewhat flat.
Eli Lilly shares were off 33 cents to $64.35. Shares of Dunkin' Donuts also fell sharply after the coffee and donut chain reported that its sales missed forecasts and it issued a warning. Dunkin' says it'll be a challenge to meet the low end of its sales growth target for the year. Despite challenges, the CEO still optimistic.
Even though I'm very excited about the programs we have in the fourth quarter, I temper that with the fact that the consumer, as we discussed, is in a little bit of a difficult place. We're going to try and get our comps as high as possible, but I want everyone to know my biggest concern is franchisee profitability, and we're doing a great job.
Despite that enthusiasm, the stock tumbled 6% to $44.
Report out today says Sears is going to lay off 5,500 workers, close more than 100 of its stores, which include Kmart and Sears. It's going to do it before Christmas. Sears has been struggling to cut costs as sales slumber, and it has already closed 100 of its locations in the first half of the year. Shares higher after that report, up 4.5% to $35.95. KLA-Tencor surging in initial after-hours trading on its earnings report. Profits there above estimates. The company announced a special dividend, $16.50 a share, and it approved an increase to its stock repurchase program for up to 3.6 million more shares. The stock 1% higher before the close at 71, but look at that spike after hours. Maxim Integrated's profit topped consensus, but revenue well below target. Its guidance for the second quarter also missed, and that worried investors. Shares tumbled right after the close, as you see right there. During the trading day, the shares were about 1.5% higher, 27.66 the close.
Coming up, the surprising companies and sectors with the most at risk as the California drought drags on. That's next.
Who says the IRS is all mean and bad? The agency is changing some rules to let workers put away more for their retirements. The annual limit employees can contribute to their 401k or similar retirement savings plan will be raised next year to $18,000, up from $17,500 this year, in an effort to keep up with inflation.
The years-long California drought has been the worst on record in the Golden State. That lack of water is bad for lawns, bad for crops, and bad for a whole lot of other companies and industries. Jane Wells has more.
California doesn't have a drop of water to spare.
We saw the gutter completely flooded all the way down the street.
Cities like Sacramento have restricted watering, and so-called water cops like Stephen Upton patrol before dawn to cite violators. Everywhere the drought is taking its toll, from the lawn to the hamburger. Cattle herds are thinner, so beef is higher, and chains like Fatburger are trying to maintain margins.
It now costs 25 to 50 cents more to have a hamburger than it used to.
Now, lawns and livestock seem natural victims in a drought, but new analysis from equity research firm MSCI says you'd be surprised at which industries are most at risk. Linda Elling-Lee says a quarter of energy production for companies like Occidental, Marathon Oil, and ConocoPhillips are in regions where there isn't much water, which could be a problem as they compete with agriculture and other industries. But for utility companies in the Southwest like Xcel or Pinnacle West, it could be even worse. There's a lot of water in power used for things like cooling.
The water use of the average electric utility company, per dollar capital is, 10 standard deviations, not just 10 times, but 10 standard deviations more than all the other companies in all the other industries.
She says utilities are making changes, but change doesn't happen overnight. Oil, electricity, beef, crops, and people all competing for less water. And as the West looks to the skies for rain, Sacramento Water Conservation Manager William Granger said it's looking less likely the rain will come.
So much for the El Nino.
Yeah, it's more like a la nada. So.
For Nightly Business Report, Jane Wells, Sacramento.
And finally tonight, the kids who once told their teachers that the dog ate my homework, they've come a long way. A new survey from CareerBuilder.com lists some of the worst excuses employers have actually heard from underlings for missing work. Here are a few of the best. I'm stuck in a blood pressure machine at the grocery store. I'm not kidding. These are real things, folks. I put my uniform in the microwave to dry it, and it caught fire. I accidentally got on a plane. How you do that, I don't know. And this one at least gets credit for, or partial credit for honesty. I was in a good mood, and I didn't want to ruin it.
How do you get away with this stuff?
Oh,
Can't
boy.
make it up.
I hope my son sees that segment.
That's Nightly Business Report for us for tonight. Thanks so much for joining us. I'm Susie Garrow.
I'm going to put my tie in the microwave tonight. I'm Tyler Mathisen. Have a great evening, everybody. We'll see you tomorrow night.
Nightly Business Report has been brought to you in part by
TheStreet.com, featuring Stephanie Link, who shares her investment strategies, stock picks, and market insights with Action Alerts Plus, the multi-million-dollar portfolio she manages with Jim Cramer. You can learn more at TheStreet.com/NBR.